Standard costs are used to help managers evaluate performance and just evaluate operations in general. A standard is a cost that should be incurred under efficient operations. You're going to see that it has two parts, the quantity and the cost. And this will be, again, a tool used in performance evaluation. This is an example of what a standard would look like. You'll notice that we've got the quantity, 3 pounds, and the price that should be paid, $2 per pound. So that's $6 per unit. With labor, 2 hours at $8 per hour, or $16 per unit. And overhead applied here is $7 per unit, giving us standard cost per unit of $29. So once again, you can see that there is both a quantity and a price for each of the elements of production on a standard cost card. Keep in mind that a standard relates more to a unit while a budget is a total amount. The two do work together because obviously a standard would help you prepare your budget. Now, how are these developed to get the cost and quantity parts of this? Typically what's done is you can look at historical performance. That does have built-in inefficiencies from the past, so you might want to also interview the operating managers to identify what could be improved upon. And also engineering-based studies. These are time and motion studies that demonstrate what it should take to produce a unit and to complete an activity. Now, standards should encourage efficient operations. You don't want to hold somebody to perfection. You would really like to hold them to attainable standards. So this would be efficient operations, but with tolerable inefficiencies built in, because we know that we will have fatigue in our employees, for example. We know we'll have machine downtime. We just need to identify what is reasonable. When you're setting standards, your direct material price is of course going to include the price paid per pound, gallon, yard, ounce, but it's also going to include any other cost of obtaining your material, so any receiving, storing, handling, or discounts should be factored in. With the quantity, you should factor in how much material should be needed to make a unit, but then allow for some unavoidable waste and spoilage of those materials. Likewise, for labor, consider the labor rate, but also factor in payroll taxes and fringe benefits. For the labor quantity, identify how many hours it should take to produce a unit, but then build in rest periods, cleanup, machine setup, and even machine downtime. For overhead, you've really learned in the past how a standard is set for overhead, because the predetermined overhead rate is actually a standard cost of overhead. All right, so why are we looking at standard costing? This really facilitates planning and control. We'll be comparing actual costs to standards and computing variances, but it can also be used for inventory costing. So we would debit work in process finished goods and cost of goods sold at standard and isolate variances. But that's beyond the scope of this course. So our focus will be here on how standards are used for planning and control. Once you calculate the amount of a variance, you will want to identify if it's favorable or unfavorable. When your standard costs are greater than what you actually incurred, this is a favorable variance. And when your standard costs are less than actually incurred, this is an unfavorable variance. So in other words, you want costs to be less than expected. All right, we will be focusing on the variances for variable manufacturing costs, we are not going to look at the fixed overhead, just the direct materials, direct labor, and variable overhead variances. For direct material, you'll see that we do have two variances. One is called the direct material price variance. That is, if you pay a different price for direct materials than you had anticipated. And a direct material usage or quantity variance that will isolate the difference in cost due to using a different amount of direct material than standard. Direct labor looks very similar. You'll have a direct labor rate variance that will isolate the difference in the wage rate. If you thought you would pay $10 an hour and you paid $10.20 an hour, then you would have a rate variance. The labor efficiency variance is going to look at the difference in quantity. Did you use the right number of labor hours in producing each unit? And then the variable overhead variance, there are two parts again. The variable overhead rate variance will look at the average rate of spending on variable overhead costs, such as electricity and factory supplies. And the variable overhead efficiency variance, this will look at, is there a difference in variable overhead costs due to using a different quantity of the cost driver? That will be easier to demonstrate with numbers, but keep in mind that our coverage of variable overhead variances is going to be limited to when direct labor hours are used to apply overhead. Who is responsible for these 6 variances, and when do we need to investigate? Well, if you look at the 6 variances, direct material price variance would likely be the purchasing agent, whoever is responsible for buying materials in your organization. The usage variance, on the other hand, will typically be the responsibility of the production manager. Production managers oversee efficient usage of the inputs. The labor rate variance could be the personnel department or the HR department. That starts with hiring the right people with the right skill level. But it could also be the responsibility of the production manager if that manager uses high-skilled labor for low-skilled jobs or has too much overtime. That's going to affect the average labor rate in the organization. Labor efficiency will be the responsibility of the production manager. And variable manufacturing overhead variances, this would actually be various managers. You would have a maintenance department manager responsible for the variable part of maintenance. Electricity might be another manager, so we're not going to get to the specifics of that. Now, we just talked about the direct responsibility. Realize that there are interrelationships among variances. One variance can cause another. This is what makes management an art rather than a science. You've got to factor in the different things that can contribute to a variance. So, for example, if you purchase lower cost materials, you're going to have a favorable price variance. But these could be poor quality. That may cause an unfavorable direct material usage variance because they have to use more of the material, or it could even contribute to an unfavorable direct labor efficiency variance. If the material is hard to work with, they're going to use more labor hours to produce the inventory. I can't identify all of the things that would contribute to another variance, but what you're really looking for is when you have one favorable variance that causes an unfavorable variance, or vice versa, an unfavorable variance causing a favorable variance. When should these be investigated? Well, you really need to consider the cost benefit. every time there's a difference, you're not going to go investigate what happened, but you might set a threshold. And management will likely have a policy, something like, we investigate all variances that are greater than $5,000, or we investigate variances that are greater than 10% of standard costs. Management will need to come up with a policy that they apply for this purpose. This is a diagram of the calculations for the 6 variances. I typically use formulas, but this diagram works very well. And if you're a very visual learner, you're probably going to like using this diagram. So reference this as you do our problem, and I will demonstrate it in a few minutes using formulas. That's it for our introduction. Next, we'll work an example.